retirement accounts. You're now ready to invest in your retirement. What are the potential accounts you can use to invest your money through? Understand, these are vehicles which you use to invest through, not invest in. Stocks, bonds, ETFs, etc. are what you invest in. So let's first look at the account types. You have a traditional 401k, you have a Roth 401k, you have a traditional IRA, you have a traditional Roth, you have a simple, a SEP, a self-directed, and a 403b. With that being said, let's go over the traditional 401k first. A 401k plan is a company-sponsored retirement account that employees can contribute income while employers may match contributions. However, 401ks have contribution limits, so let's look at the 2022 limits. For 2022, employees can make a tax-deductible contribution up to $20,500 per year for workers under age 50. However, those age 50 and over can make an additional $6,500 tax-deductible catch-up contribution. These limits will get adjusted periodically for inflation, so make sure you check each year what the limit is. In addition, if the employer also contributes or if the employee elects to make additional non-deductible tax contributions to the traditional 401k account, there is a total employee-employer contribution amount for the year. And for 2022, for workers under 50 years old, the total employee-employer contributions cannot exceed $61,000 per year. Including the catch-up contribution for those 50 and over, the limit is $67,500. The earnings in a traditional 401k account are tax-deferred, which means you'll pay taxes when you make the withdrawals. You must be at least 59 and a half or meet other criteria spelled out by the IRS, such as being totally and permanently disabled when you start to make withdrawals. Otherwise, you usually will face an additional 10% early distribution penalty on top of any other tax that you owe. Lastly, there are required minimum distributions that must be made. After age 72, account owners who have retired must withdraw at least a specified percentage from their traditional 401k plans using IRS tables based on their life expectancy at the time. Next is a Roth 401k. The best part of a Roth 401k is that the earnings are tax-free when you withdraw them during retirement. The contribution limit is the same as a traditional 401k, $20,500 for 2022. However, employers' match contributions will go into a traditional 401k, not a Roth 401k, if an employee utilizes a Roth 401k for their retirement savings. For workers under 50 years old, the total employee-employer contributions cannot exceed $61,000 per year, same as a traditional 401k. And then including the catch-up contribution for those 50 and over, the limit is still $67,500. Again, you must be at least 59 and a half or meet other criteria spelled out by the IRS, such as being totally and permanently disabled when you start making withdrawals. Otherwise, you will usually face an additional 10% early distribution tax penalty on top of any other taxes that you owe. Withdrawals of contributions are non-taxable and penalty-free, which is a nice benefit. Roth 401ks are subject to required minimum distributions at age 72, unlike a Roth IRA. Lastly, Roth 401k contributions must be made by the end of the calendar year, meaning the 2022 contribution deadline is December 31st, 2022. Now, the third type of account you can invest through is a traditional IRA. A traditional IRA is a type of individual retirement account in which you can make pre-tax contributions and the investments in the account grow tax deferred. In retirement, you pay income tax on withdrawals from the traditional IRA. You open a traditional IRA at a brokerage, robo-advisor, or a bank. If you get one from a broker, you'll be able to invest in stocks and bonds. IRAs from banks generally offer certificates of deposits and savings accounts. The contribution limits for 2022 are $6,000 and $7,000 if you're 50 or older, even if you're also contributing to a 401k or other workplace savings plan. Generally, you or your spouse must have earned income to contribute to an IRA. Contributions may be tax deductible. For example, if your income is $60,000 and you contribute $6,000 to a traditional IRA, then your taxable income that year will drop to $54,000. You're not taxed on gains until you withdraw them. Early withdrawals may be taxed as income and assessed a 10% penalty. Let's take a look at the table that shows the pros and cons and a table that shows the limitations for tax deductibility purposes. Again, these limits will more than likely change yearly, so make sure you look to see what those new limits are each year if you're going to go ahead and contribute. Now let's talk about a traditional Roth IRA. A traditional Roth IRA invests post-tax income, which is income you have already paid taxes on, and then any earnings on your invested post-tax income are tax-free when you receive distributions during your retirement. However, there are a few exceptions where you can receive distributions on the earnings before 59.5 without penalty and taxation. And also, for 2022, you can contribute up to $6,000 if you are younger than 50 and $7,000 if you're over 50. Also, to qualify for tax-free distributions on earnings, you'll need to wait 5 years from the first time you contribute to the Roth IRA before withdrawing earnings. Just like a Roth 401k, here is a nice unspoken benefit to a Roth IRA. While you're trying to save for a 6-month emergency fund, it might be advantageous to put at least part of those funds in a Roth IRA and earning money in a Roth instead of a high-yield savings account. With a Roth IRA, you can be conservative or aggressive with your investing. You can invest in cash and earn interest with no risk, or you can invest in stocks and let it roll. However, if you ever have an emergency and need cash, the contributions you made to the IRA, not the earnings, can be withdrawn at any time without incurring a penalty or taxes, unlike all other IRAs. Therefore, a Roth IRA can be used as a de facto emergency savings account while building for your retirement tax-free. However, if you withdraw the earnings on the invested capital before you're allowed, it will trigger a 10% penalty on the amount of the earnings you withdrew along with taxes. There are a few exclusions. Unfortunately, not everyone will be able to directly invest using a Roth IRA because there are income limits. These limits will more than likely increase yearly, so if you want to invest using a Roth IRA, please talk with a financial advisor or research to find out the limit for that particular year. In addition, you can make contributions to your Roth anytime between January 1st of the contributing year and when that year's tax return date is due, which is usually April 15th of the following year. For example, you can make your 2022 contributions between 1/1/22 and 4/17/23. Tax returns are due on 4/17/23. The April 15th falls on a Saturday this year. To give you an idea of what I'm talking about, here's a table for 2022 showing those limits. Now let's say you want to contribute to a Roth IRA, but unfortunately, you make too much money and are over the income limit. There is still a way for you to do this. This is called a backdoor Roth IRA conversion. A backdoor Roth IRA conversion works like this. You open up a new traditional IRA, make non-deductible contributions to it, then convert it into a Roth IRA. There are no income thresholds limiting who can make non-deductible IRA contributions, although you still need to obey the annual IRA contribution limits. Anyone can convert traditional IRAs to Roth IRAs regardless of annual income. However, a backdoor Roth IRA is most useful to high earners whose access to a workplace retirement plan makes them ineligible to deduct their traditional IRA contributions in the first place. You can also do a backdoor Roth IRA by converting deductible contributions held in a traditional IRA or a traditional 401k to a Roth IRA, although you will probably owe taxes on the money you convert. In addition, there are also some special considerations for a backdoor Roth IRA. There are not one, but there are 2 5-year rules for backdoor Roth IRAs. The first 5-year rule states that in most cases, even if you're over 59.5, you generally cannot withdraw Roth IRA earnings free of taxes and often penalties unless your first contribution to a Roth account was made at least 5 years ago. And the second 5-year rule states a backdoor Roth IRA is categorized as a conversion, not a contribution. Because of this classification, you cannot access any of the funds held in the converted Roth IRA without penalty for the first 5 years after the conversion, which includes the conversion amount you pay taxes on. This rule differs from a contribution to a Roth IRA, where you can withdraw contributions anytime tax and penalty free. If you do a backdoor Roth IRA conversion every year, you must wait 5 years to tap into each portion you convert. Otherwise, you risk paying additional penalties on money that's already been taxed. There are exceptions to this requirement, though, if you're 59 and a half and older or if you become disabled and die. Some good news is the 5-year clock starts ticking on January 1st of the year you made the first conversion, no matter when you made it during the year. For example, if you made a conversion on December 15th of 2018, the 5-year clock for that conversion begins on January 1st, 2018. Therefore, you would not be able to touch any of that conversion until January 1st, 2023. Remember, there is a new and separate 5-year clock for each conversion made. In addition, one should be aware that there is also a pro-rata rule that is pretty complex that could generate unnecessary taxes. Therefore, if anyone is thinking about doing a backdoor conversion, one should consult a professional advisor and a CPA to discuss if it's worth it and if there are going to be any tax and regulatory consequences from the conversion, along with the steps needed to make sure it is done properly. Now, let's explore a simple IRA. A simple IRA is a retirement savings plan tailored to the needs of small business owners and sole proprietors. Like other workplace retirement plans, both employers and employees can contribute to a simple IRA. Like a 401k, money saved and earned in a simple IRA is tax deferred. Withdrawals during retirement are taxed at ordinary income rates. Unfortunately, simple IRAs are not available as Roth accounts. Employees may participate in a simple IRA if they've received at least $5,000 in compensation during any of the 2 previous calendar years, and they expect to be paid as much that in the current year. Additionally, if an employee receives union benefits, employers do not have to let that employee participate in a simple IRA plan. For 2022, the simple IRA contribution limit rises to $14,000 or $17,000 for people 50 and older. Like other tax advantage retirement plans, you pay taxes at the current income tax rate when you withdraw from a simple IRA in retirement. Withdrawals made before age 59 and a half may be subject to a 10% penalty in addition to any taxes you owe. With the simple IRA, this penalty rises to 25% if you take the money out within 2 years of when you first started contributing to the plan. However, you may be able to avoid the early withdrawal penalty if you have major unreimbursed medical expenses, have a higher qualified education expense, or use what you withdraw to purchase a first home, among other qualified exemptions. Unfortunately, though, you still have to pay the taxes on your early withdrawals. Then there is a SEP IRA. A SEP IRA is an employer-sponsored retirement plan that can be set up by a sole proprietor, partnerships, or corporations. You must have earned at least $650 from an employer to qualify for a SEP. A SEP IRA annual contribution limit is significantly higher than those for a traditional IRA. A key fact here is employers, not employees, make contributions to SEP IRAs, and the decision about whether and how much to contribute each year can vary. However, employees manage the investment decisions of their SEP IRAs within the limits set up by the plan's trustee. Guys, one big advantage of a SEP IRA is the amount that can be contributed annually. As of 2022, contributions cannot exceed the lesser of 25% of the employee's compensation for the year, or $61,000. Again, you will pay taxes on withdrawals during retirement. Now, if you're a savvy and seasoned investor and want to invest in something other than through a conventional IRA, a self-directed IRA may be for you. A self-directed IRA is a type of individual retirement account that allows you to save for retirement with assets that are off limits for conventional IRAs. You will also determine if the IRA will be treated as a traditional IRA or a Roth IRA, and the annual contribution limits are the same as the limits for traditional and Roth IRAs. In a self-directed IRA, you can own the following non-traditional assets: real estate, undeveloped land, promissory notes, tax lien certificates, gold, silver, and other precious metals, cryptocurrency, water rights, mineral rights, oil and gas, LLC membership interest, and livestock. Unfortunately, you cannot currently invest in life insurance or collectibles, like artwork, antiques, or precious metals that do not meet IRS purity standards. If you do, the amount you spend will be considered a withdrawal, and you'll be on the hook for any applicable taxes or early withdrawal penalties. So let's now look at the benefits and drawbacks of a self-directed IRA. The benefits of a self-directed IRA, it allows for much diversification and a potential for higher returns. However, it also reduces your liquidity. The cost can be very high. You have limited protections and a higher probability of IRS rules violations. So to understand this a little better, I'm going to tell you the best self-directed IRA investment story of all time. Peter Thiel, who is a famous venture capitalist, took advantage of a self-directed IRA and now has billions of tax-free dollars when he retires. It's kind of a sore subject with the U.S. government because they didn't actually envision this happening and cannot get any tax revenue from it. So here's how it went down. Peter set up a self-directed IRA in 1999 and invested $1,700 in PayPal stock when it was first created as a non-public stock. And that amount grew to $28.5 million. He then took that money and invested it in Meta/Facebook and other investments and turned that into approximately $5 billion in 2019. Now, if this is the type of a retirement account that interests you, please contact a financial advisor that specializes in this, as there are many rules and costs associated with a self-directed IRA. If you do not understand all the rules or costs, you could make incorrect moves and it could end up costing you a lot of money. And finally, if you work for a public school or a certain charity, then a 403B is a retirement plan you could partake in. I hope this overview of all these retirement accounts will help you make the proper decisions for which account or accounts you will choose to invest through. Once again, if you have questions about any of these, please consult with a professional financial advisor.